Vinay, always good talking to you. Thank you so much for taking the time out and being with us. Now, before we get to the macro, Vinay, and I want to talk about the RBI policy takeaways, etc. as well, but since we're on the topic of IT companies and layoffs, etc., I mean, what borders on legality and ethicality is a separate conversation, but does this give in any fashion an indication of what could happen to the near-term fortunes of IT companies, especially the ones which are doing large layoffs?
Well, it clearly tells you that the IT sector is having a lot of uncertainty. If your growth expectations globally were being questioned because of global slowdown, now the cost element will also increase. The advantage of having Indian labor working in US are, you know what you're training, but B, the cost advantage. Now, if you start hiring more people globally, your EBITDA margins would contract because your cost would move up as well. So ineffectively, the IT sector is having two headwinds. One is on the top line because of a slowdown, and the second is on the bottom line because costs are moving up. So there is stress in our eyes for the IT sector for sure. Will this change? Will this go away? That's another big question. And somehow, if you were to talk about tariffs, which everybody does talk about, or what's happening for U.S. tariffs in the future, in a way, the U.S. President has put tariffs into the IT sector by questioning the H-1 visa. People can say in the longer term, you'll go back to more offshore-centric work, which will improve margins. But in the shorter term, I think on-site is here to increase and costs are going up. So that's not good news.
Got it. Okay. Okay, Vinay, what have you made of all the rumblings in the last 1 month since the time we spoke? Most noticeably, the policy statements that have come in from the Fed as well as RBI, which has paused, but it seemed like a policy tailor-made for banks.
You said it really well. So very quickly on Fed didn't have much of a choice because if you've got a duration of about 71, 72 months for the debt of US, $6 trillion comes up for renewal every time. If you do not reduce the debt, the interest costs of debt, the incremental cost which Fed would pay for their debt, $6 trillion times, let's say 4.5 plus 50 basis points markup, would be $300 billion, as against the $6 trillion 5 years ago was getting 0 to 0.5% interest plus a 50 basis point markup. So there's a $250 billion interest element which is increasing for the fiscal of Fed, and it is in their incentive to cut rates lower, leaving aside the consumption angle altogether. So Fed has done what it had to. There's not too much of choice they had. But coming down to the RBI front, RBI had done two amazing moves, right? They have cut interest rates already by 100 basis points this year. The impact of that has to be seen. They had suggested CRR cut of 100 basis points. So that 25 basis points of the CRR cut has happened, 75 basis points is left. So what they've done is they've kept a bullet with them. They've not changed the rate in the short term. The market is clearly viewing that as negative because if rates were cut, consumption could have become a little better. Having said that, if you think of what RBI is doing, first there's a GST relief come to the consumer. That would get inflation down further. So they're waiting for that act to trickle in for the consumption to see if really there is a consumption slowdown even post that. And if the answer is yes, then they could always cut rates. Also on the liquidity front, what RBI has done is it's managed liquidity pretty well for the banking system. We are not negative. We are 0 to 2 trillion rupees on the market. So liquidity is not a problem. The third big change, I think what RBI has done is, be it the risky assets, be it for infrastructure, be it for MSME, they're suggesting that, they could take that lower. So there is liquidity, for growth for the country. So I think the government and RBI is doing what it takes. We can be cute and say that inflation numbers could have been cut further. So RBI again has that one ammo with it. And the GDP numbers have raised. So as far as the economy is concerned, thumbs up to India and RBI for what they've done. And they still have bullets left in case things slow down, my friend.
Okay. Vinay, one question I have with you is the way India is pegged right now with global peers. Absolute underperformance is what we are seeing so far. However, everyone is now talking about the opportunity that lies when you talk about India with the reforms that are coming in. If that is the scenario, are you seeing anything which is unusual with the underperformance? And two, where are you seeing those opportunities? Because IT, we're talking about headwinds. BFSI, yes, if the FIs have to come back, these two are the largest sectors where you do see FIs coming back as well. So how would you advise investors to approach the markets at this juncture?
So I'm going to break this question up into two. First I'm just going to take on the outperformance and underperformance of the sectors in 1 to 3 months, and come to what themes we are advising investors to play. So having said that, you've started really well again. The markets globally are up 20 to 25%. In dollar terms, India is down 5 to 10%. So there's a 30% underperformance come in the last 12 months. And guess what? Indian GDP has grown. The earnings of India has grown 6, 7, 8%, not 12 to 15%. So there has been a time correction and even a PED rating for lots of places in the country as far as stocks are concerned. Moving on to stocks or sectors which have done well in the last 1 month. Clearly, the auto sector has done a lot better based on news of GST. So has banks and metals. Interestingly, FMCG sector, has moved to the underperformance zone in the last 3 months. IT and healthcare have been consistent as underperformers since the time the Trump dynamics have come into picture. So people are looking a lot more at geopolitical risk coming in. Going to your second question, which is what would we advise investors to do? I think this is the time for investors to look a lot more of what's happening globally. The currency is at 88, 88 versus the dollar. But if you could see it versus the European currency, it's further depreciated a lot more. So the currency has been questioned in India because of what Trump has done in terms of tariff. If we had to take just the net bill of what US India gets from US and exports, that's $86 billion. $35 billion of that is exempted, but for the remaining $50 billion, as long as the tariffs are 25 to 50%, it's fair to assume at least of that $50 billion, you could have $1 to $2 billion every month slipping away from India as far as the current account deficit is concerned. So though it's curtailed now, there is some stress in the system because of, if I may use the word, as geopolitical risk. So in such an environment, we would put our eggs in three themes. The first theme is the Capex cycle. The good news is the Indian government has, for the first 5 months of the fiscal year, spent around 40% more on a year-on-year basis. About 4.3 trillion of its 11 trillion has already been spent. So that's really good news. People were concerned that if GST comes in and some part of the pie is taken in, what's going to happen to Capex? So, that's partly been addressed by the government. So that's some place where we are very, very positive on. The second is financials and consumption put together. This is the space which probably the FIs would look at even first, more before the Capex space comes in. Out here in the financial space and the consumption space, I think two spaces in particular we would like would be, the hotels, maybe three, telecoms, and investments in capital markets here, because the growth is being buoyed by the SIP inflows coming into the country. And finally, the manufacturing or the Make in India theme, which we think is going to take off in the country, is taking off and will keep on taking off in the country because of the moats India is making in certain spaces. That could be in electronics, semiconductors, CDMOs, or pharmaceuticals. Or otherwise where you're seeing a good production rush. So these are the three spaces I think the FIIs or even domestic should look at, but more so with a bottom-up basis. You can't blindly buy sector classes currently based on the amount of uncertainty the global data is putting out.
Got it. Okay. Vinay, interesting that you're choosing Capex at the current point of time, and we spoke about it the last time as well. Maybe you briefly spoke about it, but there seems to be a clear bent towards consumption. Though the one thing that looked very interesting in the RBI policy to me was the RBI allowing banks to finance acquisitions, which technically isn't Capex, but in some sense is more a corporate expenditure. Why Capex at the current point of time?
See, our perspective, home bias is more important than global bias. That's step one. One of the key problems, and you spoke about TCS and layoffs, one of the key problems India has is job creation. So, how does the government solve the job creation part? I think the only way is spending more in capex. The private capex is not taking off as much as you and I would want. Utilization rates are still, 78 to 80%. So you probably got a year more before really private capex takes off in a big way. So technically, the government is hitting both shots, right? One is consumption. In the consumption part, we're actually more bullish on the capex part than the consumption part. In the capex part, you can directly see, what's happening on infrastructure, what's happening to cement companies in terms of demand, what's happening to the ports, how certain pipeline networks are coming up, what's happening to the piping company as well as the tube companies. So the demand coming in from, I would say just construction or infrastructure being built as the government has spent this 4.3 trillion, can be seen. And, hopefully when the results come out, you'll hear a lot of news out there. So that's something which is a home bias, domestic consumption growth for the capex industry. But on the other side, what we should also remember is GST got applicable from September 22nd. And from August 15 to September 22nd, there was about 40 days and a 90-day tenure for a quarter. There was confusion, so there was a slowdown. So the quarter which comes up may surprise you for the negative for the consumption space. Because technically, even if you're up 20 to 25% in the last 10 days since GST has been applicable, you're not going to be able to cover up what you lost in the quarter. You've got numbers as much as 300 to 400 basis points, for the FMCG companies, which could have a revenue question mark. You could have, people are expecting the auto sector to do exceptionally well for data which has come out in the last month. But if I would keep the two-wheelers aside for a bit, and I look at the domestic consumption for the four-wheelers, even that number technically on a quarterly basis is negative. You're waiting for the festive season for them to happen. And post that, will you get the impact? Now, if GST could get profits of the auto companies up by 20% and the stocks are up by 20%, that's understandable. But what if, the profits are up only 2% on a year-on-year basis and these companies are up 20%? So for me, it is more discretionary spend consumption like hotels or telecoms than even consumption in that platform. So that is why CapEx is a lot more easier as a theme for us to play.
Vinay, my last question. FIs have been sellers. We just have a minute or two for the response. What will get them back in terms of investments in the country? And two, are you seeing any arrest in terms of FI selling?
So there, very interesting question again, right? FIs have sold immensely. They're at a 12-year low at 16% of their ownership. What can get them back is first the currency. The currency has to stabilize. The DXY has fallen versus the dollar. Every other currency has done better, but not the rupee. So that has to stabilize. So that's step one. Step two, the amount of IPOs which are coming in are taking in 200 to 220 billion of inflows going into them. So technically, even that is a question mark of what comes into the equity markets. So if you add these two, what FIs want to see is robust growth. They're probably waiting for the quarter for the structural reforms to happen and see the dollar stabilize. Once these two get done, I think, FIs with such a low ownership, I think in the next 12 months, it would fair to be bet that they would come in a lot more. But timing would be when these two elements are taken care of. First is the rupee stabilizing, and second is you see some more earnings ticker come in once the reforms have taken care of it.
Stabilization in terms of rupee and an earnings upgrade, that should be something that could be triggers for the FIs to come in. But thank you, Vinay, so much for joining us on the show. Always a pleasure to speak to you at NDTV Profit.